Brian, did you know that if you took Warren Buffett's stock price and cut it by 99%, it would still wallop the S&P 500 over the last 60 years? Well, I've got something outrageous to say today. I believe Warren Buffett would have been more successful as a real estate investor than he even is in the stock and equity world. So we're going to talk about that on the show today. And I'm going to introduce a brand new concept to real estate investors that I'm guessing you've never heard of.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 508. Paul Moore is here with me today from Wellings Capital. And Paul is someone I admire greatly in this business. Paul, you've been on the show multiple times. We've talked about multifamily. We've talked about self-storage. We've argued about waterfalls and internal rate of return versus annualized return. And you're back today to just kind of talk about what you see as being opportunities in the market as it exists today, what you're staying away from, and just some of your thoughts on investing and where people should be considering putting their money right now. So thanks for being here today.
Such an honor to be here again, Brian. What are we going to argue about today?
I really am interested, Paul, in what you're up to, because you always put out really good articles, and you've got your eye on a lot of different types of investments, and you sort of have your finger on the pulse of what's going on in this business. So I thought it'd just be a good opportunity to find out what you're up to. Like what are you working on right now?
Who was it that said the rumors of my death have been greatly exaggerated? Was that Mark Twain or somebody? I don't know.
Mark Twain, Winston Churchill, one of those guys.
Yeah, well, the rumors that we're investing in Rescue Capital, which you asked me about in the pre-show, are greatly exaggerated. We are not investing in Rescue Capital.
What is Rescue Capital, and why aren't you investing in it?
Let's back up. We're investing in preferred equity. And preferred equity, as many people know, is sitting in the middle of the capital stack, often behind senior debt and in front of common equity. And most people think when they're investing in real estate, I'm either investing in the debt or in the equity. But if you look back to 2008, when everything was about to fall off, actually everything was in the process of falling off a cliff, Warren Buffett invested in a financial company, a little company called Goldman Sachs. He put $5 billion in Goldman Sachs when nobody would touch financial companies with a 39.5-foot pole. But he invested in preferred equity, which is a safer spot in the capital stack. It has a buffer, a common equity buffer, if you will. And it's not as safe as debt, but it's got, in some ways, often has debt-like returns because it has an annual current pay coupon payment or monthly payment. And then it also has a pre-negotiated upside. It doesn't have unlimited upside, typically, like common equity, though it can be negotiated, but it also is much safer in the sense that you're getting paid all along the way. And if things go south, the common equity takes the first hit or could even be potentially wiped out completely before preferred equity is touched. Now, a lot of folks think because there are preferred equity deals out there that are rescue capital right now. Some people are doing rescue capital or preferred equity, if you will, for their own deals even, that they're the same thing. Well, preferred equity, Brian, could be for a new development. Let's say the bank's saying, hey, we're not going to loan you 70% anymore like we plan to. And let's say they have 30% in equity ready to go. We're only going to loan you 50. Well, preferred equity could come in and put that, plug that 20% gap in the middle of the capital stack. It could also be for an acquisition, like a value add acquisition. It could also be for a refinance. That makes a lot of sense. Let's say someone's got an old 3.5% interest rate on a 12-year note and they don't want to refinance it, but they want to extract some of the equity that they've gained by doing value adds over the years. That's a really fairly, safer type deal. And then the fourth type, and there may be more I'm not thinking of, but the fourth type and the one that people are talking about, of course, is rescue capital. Let's say a deal's failing. It can't make its monthly debt payments. It's not paying investors anymore. They insert preferred equity in. And of course, preferred equity could potentially rescue the deal while they get back on their feet. And we're not doing any of that. And we're not doing any development deals. We are doing the other two type, which would be a value add acquisition or a recapitalization. We see this as the natural next step for Wellings. Wellings, you may recall when we met, was a multifamily syndicator. And I think we failed as a multifamily syndicator on a number of accounts. But one way was we just were unwilling to overpay. We were unwilling to use risky floating rate debt. We were unwilling to, in our minds, roll the dice. And I had a lot of friends. I'm in a mastermind with 9 guys. And I was the by far least successful guy in that mastermind for years. Those guys were making so much money for themselves and their investors. And I was genuinely happy for them. A little jealous, but genuinely happy. But I also knew that if things went against them, that they could get in big trouble. And I actually met with a syndicator this morning for coffee. He just happens to be in my part of Virginia. We got together and, like many, many others, those interest rate hikes just were crushing. 11 interest rate hikes in 16 months, Brian, starting in March of 2022 was crushing to a lot of people who were using short-term floating rate, debt. And so we didn't get caught in that, thankfully. And, I think we were in a safer spot. And this is the next evolution for us. To give you a long answer to your question, we're looking at preferred equity. I'll take a breath and then I'll tell you what else we're doing.
What is the difference between preferred equity and mezzanine debt?
They're both in the middle of the capital stack. And honestly, a lot of deals might have either mezzanine debt or preferred equity. Mezzanine debt is a little safer. It's got a lien on the property. It can foreclose. Now, preferred equity can also have forced sale rights, by the way. Mezzanine debt does not, because it's debt, it's taxed differently. The gains are taxed differently. There's no depreciation. There's no paper losses from accelerated depreciation. Losses, especially with the new big, beautiful bill passed, that's going to be a big deal. But mezz debt is a little safer. It typically doesn't have as much upside, but it could. Mezz debt or preferred equity could have, let's just say 8 or 9 or 10% current pay cash flow. And then let's say 5-6% accruing compounding upside that's paid out at a liquidity event.
Are you seeing a lot of rescue capital out there in the market right now? And what do you think of those types of deals? Do you find them to be a little too risky?
I don't think they're too risky for somebody who has that risk profile. Wellings Capital, I don't think they're wrong. Certainly not wrong. I don't think Bitcoin's wrong. I just think you just need to know what you're doing and you need to know what you're investing in. Little side tangent, Warren Buffett was asked at an annual meeting, a question about Bitcoin. He said, well, if you asked me, could I buy 1% of all the apartments in America for, I think he said $25 or $35 billion. And he said, completely as an example, he said, I would say, absolutely. What about 1% of the farmland? Absolutely. What about 1% of the Bitcoin? He said, I wouldn't give you $25 for all the Bitcoin in the world. And he said, because it doesn't have a real easy to calculate value based on future cash flow. And that's a side comment. But my point is, rescue capital, it's riskier, but it also can have tremendous returns, especially if the people are prepared to foreclose and take the deal over.
What else are you seeing, doing in this market, and what's on the schedule for you?
We did 7 or 8 or 9 preferred equity deals in a row. We had been doing common equity deals for years. Then we did a little slice of debt once when things were going south in 2022. And then we were like, well, let's do preferred equity. And so preferred equity, as I already described, might have a 7, 8, 9, 10% current pay cash flow, and then 5, 6, 7, 8% compounding accruing upside. Okay. So it might be a total coupon of 15 to 17%, just as an example, of course. We liked that, but then we saw some deals and we even back tested some older deals and said, wow, if we would have been in preferred equity on this deal, we would have got our 16.5%, but we would have missed 30% upside. And, we hate to miss that. So we put our heads together on the team and said, what if we can get the best of both worlds? And we came up with something called JV hybrid equity. So it's JV, joint venture, because we're typically the largest investor. We get on the GP. We're coming in with, I'll give you an example in a minute, a high amount of equity. We get forced sale rights. We get budget approval rights, just like preferred equity. We are lower in the capital stack in the sense that we're in a safer position, that meaning there's a common equity buffer between us and loss. The difference is with JV hybrid equity is there's no negotiated coupon payment, which means we don't have a negotiated cap. It also means we don't have a negotiated bottom, which means, if the property does not support, let's say, a 9% current pay cash flow, we don't get our 9%. We get what everybody else does on the equity side, whether it's 2% or 7% or 0, we get that. And then, but if it sells and there is for example, 30% return, and that was just purely an example, then we would get that same return as the common equity investors. So we would get the upside. Where we're a little more protected is, like I said, we get those forced sale rights and we get some management approval rights, but we're also lower in the capital stack. So if something goes south, and I'll give you an example in a minute, it would affect the common equity investors before it touches us. So an example would be a multifamily deal in Texas that we did. And we put this out there, so I'm not telling anything that everybody else doesn't already know. It had $30 million in Fannie or Freddie debt that was being assumed, agency debt. It had $21 million in equity. We brought $14.5 million of that equity. So they brought $7.5. That was the GP, friends and family, and then LPs brought that $7.5. So let's say that deal that was bought for $51 million. By the way, it was appraised over $60 million. It was kind of crazy. But let's say that $51 million value went down to, say, 48. Well, the common equity investors would lose 3 of their 7.5. In other words, they would take all that hit. If it went down all the way to, let's say, $45 million, well, they would take $6 million in hit. They'd have $1.5 million left of their equity. We still wouldn't take any hit on the principal. And so that's how JV hybrid equity works. We're looking to do more and more of those types of deals in addition to preferred equity.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
Do you bring that in at the beginning of the syndication, or are you taking that concept into existing syndications that need the additional equity?
No, it would only be at the very beginning. So I guess another way of asking your question would be, would that work on a recapitalization? I'd never thought of that question before, and I'd have to really think through it. But we've only done it on new acquisitions so far. We've done two recently. One was a mobile home park, and one was the multifamily one I described.
That's an interesting JV hybrid. And it's basically you're bringing this equity to the capital stack, but it's not necessarily like the LP, limited partner equity. You're protecting your principal. You are still benefiting from the tax benefits and the appreciation and the cash flow, but you're in a more protected position. I've never heard of that before. Is that something you came up with, or is that something that's existed in the industry and I just wasn't aware of it?
Troy was the first one. He's our managing director of investments. He was the first one to introduce it to Ben and I. That's the partners at Wellings Capital. But apparently it has been around and we were just unaware of it.
What it does is if you're able to bring, what'd you say, 14 million in equity?
14.5 million out of the 21 in equity on that deal.
Then you're able to negotiate that type of preferential treatment for yourself through a hybrid equity.
Right. And if you think about it, these folks remember I mentioned that it was appraised in the mid 60s. They were super confident about their ability to drive rents, improve it even more. And so their thought about losing money was, the thought of the LPs in their mind, there's no guarantee, of course, but in their mind, they thought it was a very low risk for them. So if you think about it, they really had to bring less LP money, less GP money, but they still get all of the upside that they would have got otherwise, as if we would have come in as other common equity investors.
Paul, before I hit record, you were telling me that you had just come from a meeting with your team, Ben, and did you say Troy was the other gentleman's name?
Ben and my other partner, Barry.
Barry, okay, and you had you're going to share some of the wisdom that was shared in that room. You mind sharing some of that?
Ben was just pointing out to Barry. Barry's not as involved. He just drops in from time to time. Longtime friend, went to grad school with him 39 years ago. But he was just sharing, that it's not the projected IRRs or the projected average annual returns or MOIC, multiple on invested capital. All those projections are nice. We're really investing in people. The more we learn, the more we realize it's the quality of the operators, the quality of their team. It's the quality, of what they bring to the table. They can say, we're going to have a 36% annual return, but it doesn't mean really a thing compared to their ability to execute and the quality of those people. The guy I met with this morning, the syndicator, was saying one of the reasons they were closing up shop is one of their key people had massively messed up on the asset management side. And it was all just revealed. A year and a half or two of mistakes were all revealed in one horrible day 2 months ago. And now looks like they're probably going to sell their assets and close up shop. That was a people problem. It wasn't the assets. The targeted returns may still be what they, the targeted returns could be whatever they were. The location was good, the property management was good, but one person who was a really, really bad actor or bad manager, I guess I should say, is causing them to have to close up shop. So we're really looking for the right people. So when someone says, do you really favor mobile home parks or multifamily or industrial right now? There was just a bad report about industrial, first time in years that they had some negative numbers today. My answer is we're really looking for the right people. And somebody says, well, do you really want to invest in the Northeast? Chicago's doing surprisingly well. What about Florida? I'm like, we're really looking for the right people. And of course, recession-resistant asset types as well. There are certain asset types we just don't invest in. We don't know that much about them.
When you talk about investing in the right people, I mean, the example you just gave about how your friend found out that their asset manager had been, basically hiding some bad numbers or bad information for over a year, and they just found out. I mean, I know, Paul, that you do a lot of due diligence on the teams that you work with and the groups you invest with. How do you protect yourself against that type of situation when those people, by all, different perspectives, might look great? I mean, how do you dig in and find those issues before they blow up in your face?
I'm going to answer another question you didn't ask and lead right back to your question. So our largest and most sophisticated investor was a partner at a famous hedge fund before he left there. And he's constantly harping on not concentrating too much with any one operator. And we're like, but this operator is so good. Look at their track record. Look what they've done. Look how well they're doing now. And he's saying, yeah, but you don't know if that guy will hire a bad apple and down the road who will commit fraud. By the way, the example I was using 3 minutes ago was not fraud. It was just bad management. But he could commit fraud. He said over and over and over, fraud is your number one risk because all the numbers look good and the people look good and the deals look good and the locations have been vetted. And so fraud is your number one risk as an investor. And I'm telling your audience that if he's right, all of you should remember that. And remember, just again, it's another strong reason that we really need to invest with the right people. Now, the question you asked was, how do we protect ourselves? Brian, when we started, we saw ourselves as doing two things really, really well. That's vetting the right operators and deals and having great relationships with investors. So we raise money from investors, we get the right operators and deals, and then we just do a good job communicating. But we've seen a third issue emerge, and of course you can see what it is already, and that is asset management. We really need to stay involved with these deals, especially now that we're not bringing $500,000 or $1 million per deal anymore. We're bringing, like I just mentioned, $14.5 million to an individual deal. We have got to stay involved. And so we're doing, weekly or bi-weekly calls with these people. We're asking them to show us their bank accounts. We're asking them to show us detailed financial records and occupancy reports and all kinds of things. And we are growing our asset management team a lot as we speak. And we have to continue that. That is the current focus of the company. We've done a good job setting up our team to find deals. We found some great deals. We've done a great job, I think, working with investors. We have 1,030 investors, last I checked, accredited investors. We have to now focus more and more and more on asset management. And just the more we learn, the more we realize how things can go wrong, the more we focus on asset management. For example, now this is on the investment side, but we're doing an NOI audit now that costs $9,000 or $10,000 right up front before we make an investment to see if the money is really coming the way and in the manner they said it was on the pro formas, for their last year, for example.
What are you working on now? I mean, I know You said you're working on a new book, and I'm wondering if you'd be willing to share that.
I'm having so much fun, Brian. I'm working on my fourth book, and it's tentatively entitled Warren Buffett's Rules for Real Estate Investors. You might say, wait a minute, Warren Buffett, real estate, I don't get it. Well, Warren Buffett, if you took his Berkshire Hathaway share price and cut it by 99%, in other words, if it went from, let's say, $100 a share, for example, down to $1 a share, it would still wallop the S&P 500, beating it by 40 or 50% in the last 60 years or so. Well, he's probably somebody who's pretty smart, probably somebody we can learn from. I think that Warren Buffett should have been a real estate investor. He's obviously not, but his principles work so well for commercial real estate. We were just amazed. The more we looked at his quotes, his principles, the way he succeeded. I could give you some examples, but the point is his principles work well for us as real estate investors. So I'm trying to make that super plain. So I've got a couple co-authors, wonderful guys, and they are Warren Buffett experts. I mean, they know the quotes off the top of their head. They know the year he said this certain thing in a meeting. They know where to find these quotes. So we've come up with about a 25-chapter book explaining Warren Buffett's principles, quoting him, telling what he did right and wrong, and then explaining how that applies to us as real estate investors. It's been so much fun.
What has Warren said that applies to real estate investing?
He says great investors say no a lot, but the very best investors say no almost all the time. Brian, this has been the biggest thing I did wrong. If you look at my whole 40-year career in business, that's the biggest mistake I made. I didn't say no enough. Gary Keller says in the book, the wonderful book, The One Thing, to say yes to your one thing, you must say 1,000 no's. And he also said, he who chases, Chinese proverb, he who chases two rabbits catches neither. And that was one of my big mistakes over the years, not staying focused. Buffett realized at super young age, I don't remember if it was 12 or 13 or what, that he wanted to be an investor, maybe before that. And he's just stayed laser focused on that. He says no to meetings. He keeps his schedule clear. He just stays laser focused. His life is boring. That's one of the reasons I'm working on another book called The Boring Investor. But his life is boring, and he says no all the time. Another principle is price is what you pay, and value is what you get. He says, I will never buy a deal that doesn't have significant intrinsic value. That could be untapped value in a property that is there, but the current owners don't have the desire or the resources or the knowledge to tap that value. A perfect example is in self-storage. I wrote a book on self-storage. You could buy a self-storage facility and the owner might say, I'm thinking of one where the folks owned it for 42 years. And they're like, yeah, there's 6 acres out back we're not using. I don't know, it's not worth that much. It's there. Wonder if we could tap that and gravel it or pave it and use it for industrial parking or RV and boat storage. Or if we could use that to put a cell tower on in the back of the property, or maybe use it for a billboard in front of the property, a propane filling station, an ATM. Maybe we could put some more storage on it. Maybe we could park trucks there and charge charge for industrial storage, outdoor industrial storage, I should say. What if we added a little showroom with locks, boxes, tape, and scissors for sale? What if we expanded the units? What if we added, I actually heard about a guy in Baltimore, added a second story to the storage units. It's a long story how he pulled that off, but he did. All kinds of value add opportunities. And a professional operator can sometimes see these things that I would call intrinsic value that the mom and pop operator never dreamed of.
Paul, how would people find out more about you? get a hold of you? And I know that you have a nonprofit that you're working with, and I'd love it if you could share information on that as well.
Do you know if you took the record profits of Walmart, Nike, and ExxonMobil, added those record profits together and tripled that number, you'd have the approximate annual profits from human trafficking. It's a tragedy. And we're trying to do something about it. We've influenced and raised and donated, to a lesser degree, over $800,000 to help fight human trafficking. We work with an organization called AIM, AIM. They can rescue little girls for $1,000 each and put the bad guys behind bars. So we provide matching funds and do all kinds of things to try to raise as much money as we can. So that group's called AIM Free. The website is AIMFree, AIMFREE.org. And if you want to mention that you came through Wellings, it's aimfree.org/Wellings. That's our company name. If they want to reach me directly, they can get some free resources, some fun stuff, some books by going to wellingscapital.com. That's WELLINGS, wellingscapital.com/resources.
That's a shocking number that human trafficking brings in so much money, something I was not aware of. So good for you for helping fight that.
Thanks.
How did you use AI in your business today?
It's funny, I am writing these chapters for this Warren Buffett book, and I used to just slog them out. It might take 4 hours to write a chapter, 1,500 word chapter. What I'm doing now is I've found that no matter how good I write it, AI can turn a phrase better. So I'm still taking the hours to write it, but I'm actually writing it in the form of a prompt, if you know what I mean. And so I am actually writing it all out. I'm not trying to carefully organize it perfectly into paragraphs and the flow and all this. I'm just writing it out in a prompt. And then I'm saying, please put this together in the best order. And I usually tell it the order, but please put it together in a chapter. And it's actually been just beautiful how well it has worked. So I'm writing it, but it is turning the phrases and it is just making it so crisp and so helpful. So I've written 3 books in the past before I ever heard of AI. And so I can do it without it, but I just think it's going to read a little better now. And I hope that doesn't offend anybody. It definitely offends some family members of mine.
What are you using for that? Are you using ChatGPT or a specialized AI program?
Yeah, I'm just using the paid version of ChatGPT.
The $20 a month version?
Yeah, the $20 a month version. I don't know what I don't know about the $200 version. I can tell you I use it an awful lot in my personal life as well, whether it's helping diagnose a medical problem for my wife and exactly what she needs to do, what exercises, etc. She hates AI. But when I was able to help her with this, she was pretty blown away, and she really was grateful for it. I use it for my personal study. I do a lot of scripture meditation in the mornings and spend a lot of time and things like that, and I use it extensively. I would say 7 days a week.
Paul, this has been a great conversation. I always love having you on the show. You've always got a lot of great information to share. And you brought up some new concepts today. The hybrid, what did you call it? Hybrid joint
JV hybrid equity.
Yeah, just that and just talking through some of your thoughts on the market, your new book with Warren Buffett's insights. It's been a real pleasure talking with you today. Thanks for coming back on the show.
Thanks, Brian. It was a real honor.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.